Maybe it'd be helpful to quickly go around the room and just say who you are and what what you do, what company you're with, so we have a sense of sort of who's in the room, and so we could be most helpful. And Angus, I love the background. That's awesome.
It's trying times. We got to all up our Zoom game a little bit.
Right, I know. But yeah, maybe I can start then. I'm Frances. I'm an investor at Two Sigma Ventures. And my quick background is I started my career as a data scientist. I worked in product at an early stage startup. We actually made bendable, flexible, dissolvable electronics. And so, but we actually had applications around it. And so it was on the software and app side of that business for that product. And then I worked on my own ideas as an entrepreneur in residence at an early stage VC firm. Got interested in venture capital. I went to business school and then worked at Highland Capital on the West Coast. Actually worked with Andrew Cleland, who was on earlier, and leading AI investments at Comcast Ventures. So everything from consumer chatbots to robotic process automation on the enterprise side. And then joined Two Sigma Ventures after that as we were raising our third fund. And so we are just south of a $300 million fund, and we invest seed through Series B. So that's the super quick on me. But Angus, do you want to go, and then I can sort of point at people if that's okay?
Yeah, that sounds great. I know my carpool karaoke will probably be a little distracting. I'll go back to the office.
Oh, I love it.
So quick background. Spent sort of 20 years. I began my career in an unusual spot. At age 18, I took a summer internship at Netscape in the mid 90s, and summer job turned into a permanent job. And since that time, been involved in founding and running two different companies. The first is called Tell Me Networks, an enterprise B2B SaaS company doing speech recognition for companies that get a lot of phone calls like airlines and banks, which was acquired by Microsoft in 2007 for around 800 million. And then I moved back to my native New England, which is why I'm involved with a lot of things in New York these days, and started a company called Upserve that Nikhil was talking about earlier, doing restaurant point of sale. Vista Equity Partners bought that company in 2017, or bought a majority interest in the company in 2017. And I'm still actually the second largest shareholder. So it's an interesting time to be 100% exposed to the sit down restaurant industry. And we could certainly talk about that another time. And then I joined Foundation Capital last year as the firm's first partner based on the East Coast. And we've been around for 25 years. We're investing out of our ninth fund, which is a $350 million early stage fund, plus sort of a $150 million follow-on vehicle. And we're typically investing either at the seed stage or Series A. And I'm typically in New York Tuesdays through Thursdays when I'm not working from home in Rhode Island, which is where I live with my family and where I'm talking to y'all from today.
Cool. So maybe let's keep it super fast. I know we only have like 30 more minutes. So just name and where you're at, maybe the type of company, just so we can tailor it to that. I'm gonna pick on Mark first.
Hi guys, I have the aquatic background because my current startup is a wave, called Wave Drowning Detection Systems. We actually provide system for commercial pools, and we're now rolling out residential because all the commercial pools are closed at the moment. I've got a 25-year background doing tech startups, including on the communications and software side, and also a couple on the hardware side. So taking advantage of all the cool new stuff you can do with hardware nowadays.
Thanks. Awesome, nice to meet you. Marissa, you're up.
Okay. Hi, everyone. Marissa Spano. I am the founder of Venom. We are a wearables company for personal safety and defense. We're kind of solving the problem of why can't jewelry or wearables be a life-saving apparatus. So there's a lot to it. There's an app, there's a wearable, obviously, and it's a wearable as a service. So given that, I've had one exit. This is my third company, and I'm a New Yorker, but I'm currently in New Jersey at a coffee shop.
Vivian, how about you?
Hi, everyone. My name is Vivian. I am the founder of Rise. I'm wearing a hat because my computer is actually too old for Zoom background, so I've been wearing this hat everywhere. And my company is a flexible and remote work platform for high-skilled women. So we're currently experiencing a surge in user as well as interest in our platform. Obviously, how we think about remote work is more than just the jobs and opportunities. We're also providing a flexible on-demand system of benefits like health insurance, financial services products, 401k, as well as community, which includes, prior to COVID, in-person community, but now we also have a digital online community in which we host virtual events. And Francis, my husband, works at Two Sigma, so this is like Two Sigma 2.0 HQ.
Awesome. Yeah, we should chat also. We invested in a company called remote.com, which doesn't directly, but we love, we've always had a thesis around remote work, and so we're actually sort of excited about this push recently to get people more comfortable with virtual.
Yep, awesome.
Cool. Paul.
Hi, I'm Paul. I am the founder and CEO of a company called Bounce House. You can check it out, bounce.house. We call it the marketing tool for people that know nothing about marketing. And we just soft launched last week. So this is a real interesting time to launch a new product, a new company. And basically our aspiration is to be like the Shopify for one-person service businesses. So think like fitness trainers, accountants, yoga instructor, acupuncturist, and basically helping them create a website and an online presence, and eventually being able to sort of almost be like a stripped down HubSpot or something for tiny businesses that are non-technical people, normally servicing their customers in real life. And so all of a sudden we're like, all these people, like no one's hiring a personal trainer to come to their house right now. And so it's been a really interesting couple of weeks. Prior to Bounce House, I founded and ran a company called Maz, M-A-Z. It's like kind of like Squarespace for apps, but used by big media companies, Forbes, Business Insider, Condé Nast. So you might have even used an app on your phone or TV if it says powered by Maz at the bottom. Nobody coded that app. They made it using Maz. And I'm excited to be here.
Great, thanks. Brandon, what about you?
Hey everybody, I'm Brandon Martinez. I am the CEO and co-founder of Sneakerhood. It's an online community for sneakerheads. I am in Bed-Stuy in my sneaker room in the house. My own little personal space I carved out just for me. And this,
I thought it was a Zoom background.
No, this is not a Zoom background. This is literally my Jordans, my other Nikes. There's a whole bunch of boxes and things all around me. So the community, the platform that I'm building is for people like me to catalog your collection and come together and talk about all the things that you love about sneakers, big and small. This is my second company. The first company was called Indie Music. If you remember all the Harlem Shake videos from 2013, we were the ones behind the scenes making sure Artist and Label got paid for all those videos. I sold it to Live Nation in 2016, where I worked for the next 3 years, essentially running that business as a division of the overall company, and left the beginning of last year to go and start this company. So we just finished Snap's accelerator program last summer, and have been working on scaling and fundraising since then. So that's me.
Thanks. Harris, where are you at?
Hi, I'm Harris. I'm usually in New York City, right now in Massachusetts. And I'm working on Talk Hiring, which is an automated mock interviewing tool, a job interview prep product. And we work with job training programs as well as high school CTE programs to help people improve their interviewing skills. Not surprisingly, there's a lot of demand right now for this product. And yeah, I used to work at X.AI as an engineer. So I've been to Two Sigma a bunch, and my sister actually interned at Maz. So she, I'm sure, knows Paul pretty well.
Wait, Amy. Oh my God.
Yeah.
I was like, your name sounds familiar, but I couldn't put it together.
Exactly.
That's insane. How's she doing?
She's doing well. But yeah, we can talk later.
Yeah, probably that makes sense. That's so funny.
Yeah.
Cool. Omer, how about you? Am I pronouncing your name correctly?
Yeah, actually, the first one today. my fifth call and the first one that pronounced it right. So Omer Golan, Israeli, based in New York for the past 7 years. Looking at Prospect Park at the moment, wondering why is it full of people. Out the window. Since I moved to New York, I started 3 companies. The first one, Internative, was sold about a year and a half later as a boutique for interaction design. The second one was a hardware company called Moonlight. I invented a projector that projects on 4 walls and a ceiling from a single light source. I wanted to give my daughter an immersive story time experience, when I put her to sleep. A hardware startup was very, very difficult. We had a tons of issues with production, manufacturing, and so on. That business closed in about 10 months or 11 months after it was opened. I founded Outernets in 2016 together with my wife, who's co-founded everything with me so far. The idea of Outernets was to create attributable marketing campaigns for physical businesses. So it's an AI-powered marketing communication system that powers digital displays. It enables the displays, understands who's looking at them, to understand what would be the most interesting things for them, and to present them to them and empower them to use to control the content user, their facial expressions, their hand gestures. Think Minority Report for the real world. When you can get actual actionable data about customers' engagement.
Cool. And then I see Jendi and Angelo, you guys are not on video, but Jendi, if you want to give your where you're working on, you can do that now. Otherwise, if not, I can move to Angelo. Right, I'm going to see if Angelo's interested in giving his. Yep. Go ahead, Angelo. Are you on?
Yeah, no, I'm just a student here to record, so nothing
okay,
really.
Great.
Yeah.
Thank you, guys. Okay, awesome. So now we're our topic is obviously sort of broad, shifting priorities. But let me first say, if you guys have specific areas where you'd want to dig into this, because I can ramble on shifting priorities broadly and consumer behavior, or go into sort of how venture capitalists are shifting priorities, and even just how I'm advising companies that I sit on the board of and that I work with, have invested in, on how they should think about shifting priorities. And I definitely think, it depends on sort of a 2-axis in my mind, which is impact on your organization as maybe like the x-axis, and the y-axis is sort of like the severity and duration of the economic impact that we're all going to experience. So maybe assuming it's a wide U or more L's in my mind is where I'm sort of advising, but then specific to companies, I think about sort of where they fit on that spectrum of impact on their org and their cash position, competitive position in the industry, et cetera. So first I'm going to pause and see if anyone had any areas they'd like me to dig into, and Angus, and sort of how we can be helpful in thinking through those shifting priorities. But yeah, any specific areas we'd like to cover?
Yeah, I'd love to hear some of your thoughts on how companies that may be doing retail technology, are now going to reprioritize their offerings. We were obviously very heavily reliant on our retail customers to open their stores, to have engagement, and at the end of January or beginning of February, most of our customers just hit pause on paying their subscriptions and dues, which I cannot get them. If they're closed all around the world, they're not making money. It's very difficult for them to keep spending money, and the same way I paused on my rent. But other than now thinking on how to reprioritize our offering and offer products to the retail businesses that are open and thriving, like grocery stores, pharmacies, and the likes. We're working on some products and offering for them, but I don't know if to spend too much time on this, because people are going to go back to normal, and then this offering will not be relevant anymore. Like, we've developed in 3 days a way to detect if someone is wearing protective gear or not at the entrance to the supermarket. So maybe we can reward them if they're wearing a mask when they're coming to a very packed location, and so on. just figure out what's the outlook, if you would shift your priorities entirely to focus on that, or you say, you know what, let's just keep doing what we're doing, what we were doing, and doing it well before.
Yeah, so that's a difficult one. I think it's sort of at a high level, I think you're doing the right thing by initially assessing the impact and sort of developing a strategy. I personally do think, and I guess maybe the key here is like focusing on what you control versus what you can't control. And part of what you can control is, your traditional customer base not wanting to spend. I think, so two things I'd say is like, if you're cutting prices, I think it's actually smart if you can weather it from a runway perspective. And the reason I say that is I think you're sort of in the B2B market, and my perspective is that VCs are also looking at metrics differently and assessing sort of what is a healthy company based on untraditional things, maybe for the enterprise, which I think are more like, customer engagement and stickiness and MAUs, and rather than, ARR, because I think that's going to be hard to sort of put a multiple on over the next couple of years. I think, all our traditional multiples are sort of like make no sense right now. So what will make sense is understanding like how much people really like your product. And I think if you have ways to demonstrate that during this time and over the next 12 months to 24 months, that should sort of be the focus, I think, for a lot of these B2B companies. And frankly, I think that's a pretty big shift. Traditionally, B2B and enterprise were not as focused on user engagement, and I think this is almost more like customer-like scoring, I suppose. And so, and I think also people are going to buy more on product than they used to, based on, like your brand, and there's a lot of options in the market. So if I think to the extent you can really demonstrate that you have the best product out there and you hook people that way is also important. It's kind of vague, but I'm trying to make it more broad for other people as well here. But does that make sense? Any questions on that? Something I've been back and forth on a bit. And I think people would disagree with me too on how those different metrics will look over the next 24 months. I also think, by the way, you're in an R&D type business. Another thing I think people might disagree with me on, but I sort of feel strongly about, is that now is the time to invest in that R&D and to do the refactoring work you've been meaning to do. Because frankly, I think, because we don't have the traditional, PE, to EBITDA, or like your COGS are going to look weird. You can sort of, this is a bit of the gimme year to do that hard work on the back end. And I think, if you look at 2008, actually, a lot of the companies that accelerated had invested in those growth options instead of just cutting costs, which I think you should be doing as well. But it actually put a lot of money into R&D to sort of, once they came out of this, they were sort of the top of the stack in terms of like, robustness of product, and had used this year to sort of maybe take a short-term impact on their gross margins to invest in that refactoring work. Maybe that's a bit of a shifting priority as well.
So if I add one more question, would you, if you do have to raise funds, would you, and there is, obviously, I mean, we had to cut our projection by like 30% at least what we expected to have this year. And, but so if the multiples are different, would you go for an unpriced round at this point? As an investor, would you agree to an unpriced round at this point, or would you want to take this opportunity right now and price the round?
No, this is no for me, but
I could share one thing that that we, when you've got a tremendous amount of uncertainty as an investor, like doing an uncapped note or something like that, I think would be pretty unattractive in this environment. However, if it's a particularly attractive deal one approach that I've been willing to take, we've done this in one company, is we said, look, let's just make up round numbers here. Let's say it was putting $1 million, or just to pick an even number, $1 million into the company. We will put in maybe 650,000 of that million, 65 cents of the dollar. We'll put in on the exact same terms as the last round you did. And we'll put in 35% on an uncapped basis in the next note. And the net effect of that is essentially that when all is said and done, assuming the next round does happen at some point down the road, look, we're somewhere between the last round price and the next round price. And, it gets more complicated because you're going to want discounts if that next round doesn't occur within 6 months or 12 months, what have you. But, a structure like that for a company that, if there's no other way for the investor to get into the company, that's a structure we would consider. Keep in mind that in an environment where there isn't a lot of capital, like to the extent you can't raise, the investors are going to have some more leverage perhaps than they've had before.
I also think, just high level, the reason I have done one uncapped note and I regretted it in my lifetime as a venture capitalist. And the reason is that you just don't know how much you own of the company. Like, I don't even know how to prioritize them in my list of portfolio companies. Like, maybe I own 1%, maybe I own 20%, like depending on what they raise in their next round. And so I think you also may not get the same sort of attention from your investor if you raise on an uncapped note, unless, there have been some like the hottest YC companies that have gotten uncapped notes. But I think, to be honest, I think it's somewhat irresponsible and sort of, I know that we're in a time of uncertainty, so it's hard to put a valuation, but I think, I think I would focus more on talking about like how the health of your business will look 12 to 24 months from now, and to make the case for the valuation you'd like to see from that perspective, rather than try to push for an uncapped note, which I think is going to be difficult. The only reason I've ever seen an uncapped note really make sense to me was because they were about to, get an FDA approval, and they were like 99% sure they were about to raise their next round within the next like 3 to 6 months. So it was sort of like, get in now, we'll get this FDA approval, and then we're planning to raise our next round in 3 to 6 months. So it was a short term, it was a limited time in which I didn't know my ownership. If that makes sense. Yeah. Vivian.
Yeah. So obviously, I think at our stage, everyone is super lean. One of the things that I'm gelling with is I am seeing a tremendous surge in my user base as well as in traffic to my site, which at this point is an MVP that we've been functioning off of for the last year and a half. My traffic March versus February grew by 48% versus December, when nobody was applying for jobs, grew by 417%. So the product is breaking. And, obviously as a very lean team, I am faced with the challenges of, do I go out there and concentrate on, fundraising so that I can build the next version of the product? Or do I, capture the momentum that we're seeing buckling down without the best user experience? And, obviously, given that I can't get out of the house, everything is going to take longer. So it's shifting priorities in times like this, knowing that, this is something, both of these things are kind of capturing my attention and needs to be solved. How do I sort of balance the two?
Yeah. So I do feel like you need to do both. What I would say is a bit personal, but my fiance is dealing with the exact same thing. He runs a robo-advisor platform, and they have insane trading volumes right now, and their back end just broke. And it's like not the time that they're like, this is the opportunity we can capitalize on all of this interest from people wanting to trade. But at the same time, like we literally just cannot host the number of trades that we have demand for. So what I suggested he do is like set up a wait list, so you can at least like show that you have this like inbound interest. And I do think you kind of have to do both at the same time. If there are ways you can give them, so I don't know exactly what your back end issue is. If there are ways you can still try to add value to the wait list without having to do like a full refactoring. But I think what I will say is it's gonna, I think remote work is here to stay. At least, I think work will change. And it just gets harder and harder to do that refactoring work. Like, I think once you've raised your A or your B, and you sort of have this large set of customers, like the barrier feels even higher, I think, to do that refactoring work, because you're just like, we could go down, we have all this risk now. Like, so I think if there's a way to invest in that earlier, it would, serve to your advantage, just because I think it's hard no matter when you need to do that work. That makes sense. I don't know, Angus, would you, any other?
Yeah, I would generally agree. The only caution might be that, if like refactoring or back, like, it's always easier to do the sort of back end refactoring types of work in your product sooner rather than later. To your point, that sort of technical debt just builds up over time. On the other hand, if you need to focus the engineering team's resources on something else to keep the company sort of default alive, then, that's kind of the approach you'd have to take. So it could be, for example, that the needs of the customer base, given the current reality, have changed so significantly that you need to alter the product roadmap to bring a feature to market that you hadn't been prioritizing as much, and kicking the can on certain technical debt.
Yeah.
So it'll be specific, I guess, to your company's situation.
I think that's a great point. I think also, like, you really should do a deep assessment of the trade-offs, because I think it would be worse if you moved resources to solve this problem and you lost customers because of it. Like, I think you want your retention to be incredibly strong right now, and that is I think that is more important than trying to massively scale up your customer base, because you can make the case for why you needed to focus on not doing the refactoring work and why you have the wait list and you haven't converted them yet. But I think it'll be hard to make the case for why you couldn't retain your customers. So I definitely agree with what Angus said on, like, really think about those trade-offs.
So I guess that, that obviously means like fundraising. So I initially I kicked off fundraising around mid-February, and obviously 2 weeks into that, COVID-19 happened.
Mm-hmm.
So I think it's just a different approach, and as well as, if you have any strategies or advice on how to get in front of more investors in times like this, when obviously, I can't have in-person meetings with them, I can't go grab a coffee. It takes much longer to get someone to trust in me and to, get to know me, especially if they're out in West Coast.
Yeah. So I listened to the earlier conversation. I think that I may be a little bit more positive on this, because I've done, I made one large investment during this time. I had met the founders once before, or one of the founders once before. I never met his co-founder. And we've invested in a lot of remote companies. We invested in GitLab, which has, 1,500 employees. They've never had a single office before, and they make really big hiring decisions without ever meeting them. So as investors, we've got to get up to speed on how to make big decisions over video. So that's point one. So I would, maybe try to look for people that have closed funds recently and they need to deploy capital. That's probably also why I'm maybe more eager, is because we just closed the fund in January. So that's sort of on the investor strategy. I think, so this is sort of me riffing, but I actually think one way to get around some of the lack of interpersonal is back it up with other types of references. So I would be really push on your customer references and be very open about talk to all these people. I would also, really be forthcoming about any references you have on yourself as a founder, whether it's from friends or people you've worked with in the past. And I'd bring that more to the forefront than I think people often it's I wait till I'm at the very end of a diligence with a company to start to do customer references and founder references. I think that we should be moving that to the forefront. And I think the more that you can also let them to touch the product and experience it. So, if you can have a beta version that you could let investors look at, or you really do a deep product walkthrough, and maybe you even have like a customer with you. Let them sit in on a sales call, perhaps, you know. But I think those are ways that you can sort of create comfort without ever, like, you know, sitting and hanging out with someone in person. It's sort of like you have all these external ways of like bringing in that knowledge and intimacy in a way. I don't know. This again is super thing.
I think knowing, I mean, I'm definitely, I think, more in agreement with Francis, but I have a partner here at Foundation where he would like really struggle to reach an investment decision without meeting the founder in person. And so I think part of it is as a founder, trying to understand who is the actual partner you're selling to. Also, how is the investment decision made within that partnership for the size of capital you're seeking to raise? Within most partnerships, you know, there's sort of typically small, medium, and large size investments, and the decision-making process around them can be quite different. You know, oftentimes, for example, in our partnership, you know, decisions less than a certain size can be made within a subgroup or even by, you know, a single GP. And so knowing who it is that you're trying to convince, I think, and their comfort level with doing things, you know, virtually and so on. You know, I think that's important.
Yep. One other idea is maybe this is personal anecdote as well, but I feel like I get to know a company better when they also bring in other members of the team. Like, even if they're not co-founders, like if you have an awesome developer who can speak to like why the platform is the most robust and why they joined and why they were so excited. I made a seed investment in a company, and one of the things that was really cool was their VP of End was just like, I was feeling this problem myself, and then I heard this company was solving it. I was like, I had to join, and it sort of it like gives you a bit more of the like color and intimacy feeling that you sort of look for in the in-person meetings. And I think the last thing I'd say is talk about COVID. Like, talk about how do you think it will impact your business, how it could be an opportunity for you, sort of what you guys are expecting. I think that shows, you know, leadership, and I think, you know, someone mentioned this earlier, but like people who aren't even like bringing it up in conversation, it's sort of like, then I'm having to do my thinking on it, and I would rather like them be the authority and thought leader on how it'll affect their own business.
Yeah, I think generally as an investor, when you have kind of constrained in-person meetings that are infrequent, you know, one nice thing about the online remote sort of medium is that as a founder, I think you can be like, this is the time to maybe share more, maybe be less cagey about trying to control the narrative that the investor is seeing, project a more genuine, like make it easier for the investor to believe you by be more willing to, for example, share the true risks that you as a management team see in the business. You know, I think things like that might help investors who are struggling to kind of get over the remote hurdle feel a greater sense of rapport and kind of belief, as it were.
I got saw the 2-minute warning pop up. Any other questions from the group?
Would you, Angus, to your point about speaking to the partner about their comfort level to find out, you know, what would make them feel at ease with executing the investment. Would you be direct about it? I mean, I'm Israeli. I'm always direct, but do you think it's?
I've not heard that about Israelis. Israelis are direct?
No, it's very new.
I didn't know that.
It's very new. Would you just be direct and tell them, you know, this is the situation. This is what I need. This is the run rate that I have. You know, how far can we go with our conversation before you would require, you know, a face-to-face meeting?
I would encourage being direct about that. I would caution by saying that my perspective is informed by having spent most of my professional career in your shoes rather than in the investor's shoes. But I've had plenty of times where I've raised capital over the years and been ghosted or whatever you call it. And so yeah, I mean, I'd rather just have direct, candid conversation about it. Oftentimes, you know, some investors are very uncomfortable with conflict, and so saying no, you know, sometimes folks can do all kinds of ways to push that off or to not tell you the true answer and so on. So look, that's going to vary from person to person, like what their comfort level is. But being honest and frank, and one way to do that too is by also showing some flexibility in how you could raise, like how much you could raise. Hey, here's a scenario. Here's what we've been thinking. Acknowledge COVID or acknowledge whatever the headwind is in the business. Here's our current ask. And if we can't get that, then like, here's another potential scenario. It's easier for an investor to say no with a BS reason if there's like, you're only offering them one option.
Yeah, thank you so much.
Cool. It was nice to meet you guys. Did you guys also,
this is great.
are you getting the notifications as well on the
Yeah.
in 20 seconds?
Countdown.
No. I feel like I need my MacGyver background.
I know. Well, it's nice to meet you. I don't know if they're sharing emails, but mine's just my first name at twosigmaventures.com if you guys wanted any follow up.
Thank you.
Awesome. Thank you guys. That was great.
Thank
Nice
you.
to meet you. Bye.
Bye.